Welcome back to EconoSphere. Everyone knows Warren Buffett is one of the wealthiest people on the planet. But have you ever stopped to wonder how he actually gets paid? It's not through frantic day trading or chasing the latest market fads. Warren Buffett's financial engine runs on something far slower, perhaps even a bit boring. It's a system built around dividend-paying stocks, a system that quietly generates billions of dollars for him and Berkshire Hathaway year after year, even when the broader stock market is facing turmoil. In this video, we're going to pull back the curtain on Buffett's approach. We'll break down exactly how he uses dividend stocks to build immense wealth, look at some of the iconic companies that have fueled his empire for decades, and finally, explore some of his more recent investments to see which ones might be poised to become the next dividend powerhouses in the Berkshire portfolio. We'll even touch on just how much cash flow these holdings generate for him daily. So let's ask the fundamental questions. How does he do it? Why is the Oracle of Omaha so focused on seemingly simple dividend stocks? And most importantly, what concrete lessons can you apply to your own financial journey? Buffett's philosophy is remarkably straightforward, almost counterintuitive in today's fast-paced investment world. He doesn't obsess over volatile price charts or try to time the market's ups and downs. Instead, he concentrates on identifying and owning solid, profitable businesses, companies that consistently generate cash and, crucially, return a portion of that cash to their shareholders in the form of dividends. His core technique is disarmingly simple. Buy wonderful businesses that generate reliable profits, often leaders in their industries, and then hold on to them for what he calls forever. And periodically, typically every few months, these businesses send Berkshire Hathaway a check, a dividend payment, purely for owning a piece of the company. Think of a dividend as a company's way of saying, "Thank you for being a part Dash owner. Here is your share of the success." For most investors, dividends might seem like a small bonus. But for Buffett, these steady payouts are much more than just a reward. They are a powerful financial tool. While many investors are glued to stock price movements and market commentary, Buffett keeps his focus squarely on cash flow. And in his view, dividends represent one of the most reliable forms of cash flow an investor can receive from the market. Consider Coca-Cola, one of Berkshire Hathaway's most famous and enduring investments. Buffett started accumulating shares in the late 1980s, and famously, he's never sold a single share of his main position. Why? Because every year, Coca-Cola sends Berkshire Hathaway hundreds of millions of dollars in dividend payments. Estimates suggest that in the year 2025, Berkshire is set to receive approximately $816 million in dividends from Coca-Cola alone. This massive income stream comes from Berkshire's ownership of around 400 million Coca-Cola shares. Based on the expected annual dividend per share, this equates to around $2.23 million flowing in daily from this one holding. And here's where it gets really powerful. Those dividend checks from Coca-Cola and many other companies tend to keep growing over time as the underlying businesses become more profitable. That's consistent, growing income arriving without Buffett having to lift a finger or sell a single share. Now multiply that effect across dozens of major holdings in Berkshire's portfolio, and you begin to grasp the sheer scale of this dividend-powered engine. Even better, Buffett often uses those incoming dividend payments to do the simplest and most effective thing: buy even more dividend-paying companies or add to his existing positions. It's like a self-reinforcing loop. Money comes in, and instead of simply letting it sit idle, he redeploys it. This cycle repeats, gaining momentum and compounding its effects over the decades. And as we mentioned, many of these businesses are so strong and well-managed that they actually increase their dividend payouts regularly. So, Buffett isn't just earning passive income, he's earning passive income that actively grows. If you've ever wondered why the world's most successful investor seems to prefer a slow, steady approach over the often hyped, fast-moving world of trading, the answer lies in this quiet, remarkably powerful strategy centered on dividend stocks and the magic of compounding. Let's dive a bit deeper into the core mindset that turns this steady income into legendary wealth. Warren Buffett famously stated, "Our favorite holding period is forever." This simple declaration is the absolute backbone of his investment philosophy. He has consistently cautioned against the temptation to chase quick profits or to abandon shares in excellent companies too soon. In a memorable analogy, he once likened selling your winning stocks while holding on to your underperformers to cutting the flowers and watering the weeds. The message is clear. Nurture your winners and deal decisively with your losers. Don't do the reverse. Buffett's strategy, when distilled to its essence, is almost unbelievably simple. Find genuinely great businesses, acquire them at sensible valuations, commit to holding them for very long periods, ideally decades, and then use the cash they generate, primarily through dividends, to acquire even more wonderful businesses. He lets the dividends do the heavy lifting. Over time, the impact of those accumulating dividend payments becomes enormous. When those payments are reinvested, buying more shares, the snowball effect truly takes hold. This is the power of compounding in action. Your money earns money, and then that earned money goes to work, earning even more money. To make this tangible, imagine you invest a modest sum into a stock that pays a regular dividend. Instead of spending that dividend, you use it to buy more shares of the same stock. In the next period, you're now earning dividends on a larger number of shares. Fast forward just a few years, and your annual dividend check will have grown noticeably, allowing you to buy an even larger number of additional shares. Over 10, 20, or 30 years, that initial dividend payment transforms into a powerful engine of wealth creation. This is why Buffett doesn't need to sell his core holdings to generate wealth. He simply lets the dividends work their magic, and the exponential math of compounding takes care of the rest. This strategy pairs perfectly with dividends because dividends allow you to benefit directly from a company's ongoing success and profitability without having to sell your ownership stake. It's much like owning a productive farm that sends you a portion of the harvest every season, but you never have to sell the farm itself. Consider the story of See's Candies, a company Buffett acquired back in 1972 for $25 million. See's wasn't a high-tech startup. It was a well-established, stable business that consistently made money. And because it operated in an industry with fewer opportunities for massive internal reinvestment for rapid growth, See's generated significant amounts of excess cash. Buffett took that cash, millions upon millions of dollars in what were essentially dividends or distributions, and poured that money into other high-return investments, funding the acquisition of other businesses and stocks that would later become cornerstones of Berkshire Hathaway. He calls businesses like See's cash cows because they reliably churn out profits with relatively low ongoing capital requirements. Buffett loves companies that don't just grow, they generate free cash flow. And that cash becomes the fuel for more investments, creating a virtuous cycle. This method has been instrumental in helping Buffett navigate through various market crashes and recessions with remarkable calm. While other investors might panic and sell, Buffett continues to collect his checks and patiently waits, secure in the knowledge that his investments are working for him around the clock. But how is this played out in the real world with publicly traded companies? Which dividend stocks have truly embodied this strategy and turned patient holding into extraordinary results? Over the decades, Warren Buffett has transformed his investments into veritable dividend-paying machines. Some of the most recognized businesses in the Berkshire portfolio have paid the company billions of dollars over the years. Let's revisit Coca-Cola. As mentioned, Buffett started buying in 1988. Today, Berkshire owns approximately 400 million shares. His effective annual dividend yield on the price he originally paid is now well over 50%. Think about that. He makes back more than half of his initial investment cost every single year in pure cash dividends without selling a single share. Next is American Express. Buffett began investing in American Express during a challenging period in the 1960s. Today, American Express sends Berkshire Hathaway hundreds of millions of dollars annually in dividend payments. And just like with Coca-Cola, these checks have consistently grown over time. This highlights another beauty of long-term dividend investing. You don't just get paid. If you choose the right companies, you often get paid more over time. These companies, Coca-Cola, American Express, and others like Gillette, acquired by Procter & Gamble, which Berkshire held, shared a crucial characteristic. They sold products and services that people buy regularly, almost out of habit, regardless of the economic climate. Buffett isn't investing in fleeting trends. He invests in enduring human habits. The real genius demonstrated here is the unwavering discipline. Buffett didn't abandon these positions when growth slowed or when the market favored other sectors. He didn't chase after fads. He planted capital in fundamentally sound, well-managed companies, allowed them the time to grow, and patiently let them pay him back through dividends. That consistency over decades is what unlocked phenomenal compound growth. And while it's easy to focus on the headline numbers like billions in dividends, the hidden engine driving this forward is the reinvestment of that income. Nearly every dividend dollar that flowed into Berkshire Hathaway became capital available to buy more stock, often adding to the positions they already held. It's the ultimate form of investment recycling. What's perhaps most impressive is the sheer reliability of these income streams. Through various economic challenges, companies like Coca-Cola and American Express continued sending those dividend checks. That kind of dependability is incredibly rare and valuable, and it's a significant reason why Buffett has remained committed to these names for 50 years or longer in some cases. But Buffett isn't just relying on the successes of the past. The logical next question is, what has he been buying more recently? Do these newer picks measure up to the legacy of those dividend giants? What has Warren Buffett been doing in the world of dividend stocks over the past, say, 10 years? Has his fundamental approach changed? Not significantly. If anything, he has doubled down on the core principles, but with an eye on the modern economy. The specific company names might be different, but the underlying strategy remains identical. Find companies that reliably generate cash flow and commit to holding them for the very long term. Let's start with perhaps the biggest and most discussed example, Apple. Buffett began accumulating Apple stock back in 2016. Many observers were surprised. Why would the king of value investing make such a massive bet on a technology company? But Buffett didn't view Apple merely as a tech stock. He saw it fundamentally as a consumer brand with an incredibly strong ecosystem and customer loyalty traits that reminded him of the enduring power of a brand like Coca-Cola, but adapted for the digital age. And while Apple isn't typically held up as a high-yield dividend stock, it does pay a dividend. For Buffett, that steady income stream, combined with the company's significant growth potential and share buybacks, represented a nearly perfect combination. Apple's current dividend yield might seem modest, but the sheer scale of Berkshire's holding makes it incredibly powerful. Berkshire owns hundreds of millions of Apple shares, translating to an annual dividend income of around $300 million. Furthermore, Apple has a history of consistently increasing its dividend over time, however slowly. This growing payout is on top of Apple's aggressive share buyback program, which effectively increases Berkshire's percentage ownership without them having to invest another dime. Then there's Bank of America, another enormous dividend-paying position in the Berkshire portfolio. Bank of America currently offers a solid dividend yield, which translates to well over $797 million flowing into Berkshire's accounts annually from this single holding. Buffett favors it because it is a large, stable financial institution with consistent earnings and clear potential to continue increasing its dividend payouts over time. More recently, Chevron and Occidental Petroleum have become increasingly important components of Berkshire's dividend picture. Following a strategic shift towards the energy sector, these oil giants have delivered both significant capital appreciation and substantial dividends. Chevron currently offers a high yield, making it a high current income producer. Occidental Petroleum's yield is lower, but Buffett sees strong long-term potential there. Berkshire has collected many hundreds of millions of dollars in cash from these two energy positions alone. We also can't overlook Kraft Heinz, a stock that has presented challenges. Berkshire owns a very large stake, nearly 27%. While the share price has faced difficulties, the dividends from Kraft Heinz have remained significant and relatively stable. The annual yield currently hovers around 5.7%, ensuring Buffett continues to collect a substantial amount of income from this position. So how do these modern picks stack up against the long-held classics like Coca-Cola and American Express? In many fundamental ways, they are performing the same critical function, providing a reliable, substantial cash flow that Buffett can then strategically deploy elsewhere. Apple might not offer the high dividend yield on cost that Coca-Cola does, but the sheer size of the investment means the annual dividend income is still massive. Chevron pays a much higher yield per share than most of Buffett's legacy stocks, and energy dividends can offer a degree of inflation protection. One often underrated aspect of Buffett's recent activity is the quiet diversification of these substantial dividend income streams across different sectors. From technology to banking, energy, and consumer staples, he has built a new, multifaceted layer of income flows designed to potentially weather different economic environments. And remember, Buffett isn't simply accumulating dividends for the sake of having a large cash pile. He values the optionality that this income provides. Having billions of dollars arriving in cash every year means Berkshire Hathaway is uniquely positioned to jump on major investment opportunities quickly when they arise. This immense financial flexibility is a key factor that has allowed Buffett to stay ahead of the game for so long. What's particularly fascinating is that some of these newer cornerstone holdings like Apple aren't even primarily known as high-dividend stocks. Yet they have become central pieces of Berkshire's portfolio. This is because, for Buffett, the dividend is just one part of the overall picture. While Apple might only yield around 0.5%, its massive ongoing reinvestment into innovation and stock buybacks are powerful engines of value creation. Apple makes itself more valuable, and Buffett's stake benefits immensely. Still, when you look at the sheer scale of cash flow, it's hard to ignore the billions Berkshire now collects each year from dividends. Add up the contributions from Apple, Bank of America, Chevron, Occidental Petroleum, Kraft Heinz, and others, and you are looking at a total annual passive income stream for Berkshire Hathaway that likely exceeds $4 billion. Buffett receives this sum year after year without having to sell a single share. Buffett has always stated his preference for companies that reward their shareholders. But the way he defines reward has become more nuanced. It's not solely about the dividend yield. It's fundamentally about what a company does with its earnings. If a company like Apple can reinvest a significant portion of its profits back into its business, and that reinvestment translates into creating immensely valuable new products and executing smart buybacks, then Buffett is absolutely on board with that strategy, even if the dividend is small. Conversely, if a business is mature, has limited opportunities for high-return reinvestment, but continues to generate substantial profits, like See's Candies, then returning that excess cash to shareholders via a dividend makes perfect sense. It's that clarity of thought, that ability to apply the core principle flexibly based on the specific business, that sets Buffett apart. This flexibility has allowed Berkshire's total dividend income to grow massively in recent years, all without sacrificing the long-term compounding engine he has always nurtured. This brings us to the intriguing question. Among Buffett's more recent investments, which might have the potential to evolve into Berkshire's next major dividend success story, which of these could possibly become the equivalent of the Coca-Cola holding for the next generation? Looking ahead, identifying the future dividend powerhouses is speculative, but we can look at candidates based on Buffett's criteria. One interesting position is Citigroup. Berkshire's significant investment in this major bank fits classic Buffett thinking. Despite past challenges, Citigroup possesses an enormous global footprint. While it might not become a top performer like Bank of America, its dividend yield offers another deep source of recurring income. There has also been a less publicized but consistent accumulation of shares in companies like T-Mobile. While not traditionally a high dividend payer, T-Mobile's strategic moves suggest a potential pivot towards returning more cash to shareholders. The company has initiated a dividend and has room to grow earnings and payouts. This could represent one of Buffett's more forward-looking bets, a company that evolves into a dividend star, somewhat analogous to Apple slowly increasing its dividend. Buffett's perspective on when a company should pay a dividend is guided by a simple rule. When a business has capital, is it better to keep it or return it? The answer? Return it when the business cannot create more than $1 of value with that capital. Dividends are great when a business has no better use for cash. But if a company can reinvest wisely and generate even more value, retaining earnings might be smarter. We see this principle comparing See's Candies to Apple. See's reliably makes money and requires minimal reinvestment, so cash flows back to Berkshire as dividends. Apple, conversely, thrives on reinvesting profits into innovation and buybacks, making the company itself immensely more valuable. Another prominent example is Occidental Petroleum. Berkshire owns over 25% and continues to buy. While the current yield is modest for now, the long-term narrative is compelling. Occidental is reducing debt and showing signs of increasing shareholder returns. Buffett seems to believe the future cash flow could rival his biggest past winners. And of course, there's Chevron. Berkshire has invested tens of billions. With a high yield, Chevron stands as a rock-solid payer that also increases dividends regularly. For a man who values predictability, Chevron is a textbook pick. Ultimately, predicting the next Coca-Cola is impossible. But the candidates, based on strong businesses, reliable cash flow, and a commitment to shareholder returns, are clear. What can we take away for our own investing? Warren Buffett's enduring success built on dividend stocks isn't about finding high-yield traps. It's about identifying quality businesses, becoming a patient owner, and allowing the power of compounding dividends to work its magic over decades. It's a strategy prioritizing consistent cash flow and intrinsic value over speculation. If you've been captivated by the power of dividends and want to learn more about how to potentially build your own portfolio focused on generating reliable income over the long term, consider subscribing to EconoSphere for more insights. Applying Buffett's principles requires patience, discipline, and a focus on understanding the underlying businesses you own. It's a marathon, not a sprint. But as Buffett's own history shows, the rewards can be truly extraordinary. Thanks for watching EconoSphere. We'll see you in the next video.